As you read through Chapter 1 and subsequent chapters, please keep in mind two primary questions that accounting, and in particular management accounting, attempts to answer. Financial accounting attempts to answer the question, are we profitable? The answer to this question is important to both internal and external decision makers. The second question, is this job or product profitable, is important primarily to internal decision makers and is a primary focus of managerial accounting. At first, to answer this question, are we profitable, seems quite simple. If revenues are greater than expense, a company has earned a profit. On the other hand, if expenses are greater than revenues, the company has a loss. While the definition of profitability is straightforward, our difficulty comes in measuring or defining revenues and expenses. One method of defining revenues and expenses is cash basis. Under cash basis accounting, revenues are reported when cash is received, and expenses are reported when cash is paid. While cash basis accounting is simple to apply, it has limitations and does not provide a very meaningful measure of profitability. For example, under cash basis accounting, if you go on a shopping spree at the mall, as long as you don't charge, or as long as you charge all of your purchases, you won't incur an expense. Consider another example. Under cash basis accounting, if a company pays cash for a new factory, it would record the entire cost as an expense at the time of the purchase and nothing in subsequent years. I hope that most of you would agree that the cost of factory should be allocated over time and the cost matched with future revenues. Likewise, financial reporting would be simple if it weren't concerned with annual or quarterly financial reporting. Over longer time horizons, say every 50 years, the issue of matching cost with revenues largely disappears. Purchased inventory would long since be sold, accounts receivable would either be collected or written off, and the lives of most long-term assets completely expired. Under a 50-year accounting cycle, cash basis accounting would pose few problems. However, for shorter time horizons, quarterly or annually, cash basis accounting is inadequate, and we must address the timing issues associated with properly matching revenues and expenses. Generally accepted accounting principles, or GAAPs, attempts to address the issue of properly matching revenues and expenses. GAAP requires the use of accrual basis accounting, and under accrual basis accounting, transactions are recorded when they occur rather than when cash is paid or received. Accrual basis accounting requires the application of the revenue recognition principle. The revenue recognition principle states that revenues are recognized when a product is delivered or services performed, regardless of when cash is received. The revenue recognition principle combined with the matching principle serve as the foundation for accrual basis accounting. The matching principle states that costs incurred to earn revenues should be recorded as expenses in the period they generate revenues. Thus, regardless of when the cash is paid, the expenses should be matched with the revenues they help to generate. For retail businesses, the matching of some costs is relatively easy. Costs that don't provide a future benefit are considered period costs and are immediately expensed. Examples of period costs include payroll, utilities, routine maintenance, and advertising. Although advertising cost hopefully provides a future benefit, they are expensed because of the difficulties in matching specific advertising expenditures to future revenues and due to the uncertainty regarding future revenues. So again, costs that don't provide a future benefit are considered period costs and are recorded directly as expenses in the income statement during the current period. Costs incurred by retailers that do provide a future benefit are capitalized. That is, they are recorded as assets and matched with future revenues. Examples of costs that are capitalized as assets include inventory, prepaid rent, insurance, plant and equipment, or other fixed assets. The cost of inventory is recorded and matched with sales in the period of the sale as cost of goods sold. The cost of the asset, the building, which was capitalized, is matched with future revenues as depreciation expense in the period that building or equipment is used to generate revenues. The cost of the prepaid rent or the prepaid insurance, again, is recorded as an asset on our balance sheet and then is matched with revenues in the period we use the rent or receive the insurance coverage. Back to the question, are we profitable? By allocating expenses over time and applying the matching rule, we can more accurately measure our profits and answer the question. The second question, is this product or job profitable, is a more challenging question. Its answer is a primary goal of management accounting. To answer the second question, we must do more than accurately allocate costs over time. We must also accurately allocate costs between products. Consider a company like Walmart that sells thousands of products. How does Walmart set selling prices? How does it know which products are profitable? How does it know which is more profitable, a gallon of milk or a tube of toothpaste? Answering these questions requires us to explore both direct and indirect costs. For a retailer like Walmart, the cost of acquiring product is a direct cost and relatively easy to match with revenues. When Walmart sells a product, it records an associated expense called cost of goods sold. On the other hand, indirect costs or overheads such as labor, electricity, and shelf space are much more difficult to match with specific products and must be allocated on some rational basis. What are the indirect costs associated with selling milk and toothpaste? Which product is likely to have higher indirect costs relating to labor, electricity, or spoilage? How should Walmart measure these costs and allocate them to each product? Again, to answer the first question, are we profitable? We only need to properly allocate cost over time. But to answer the second question, which products are profitable, we must allocate costs, indirect costs or overhead, over both time and across various products or jobs. So here are some examples of costs that might need to be allocated over time between the products. The job of allocating costs is even more challenging for manufacturing firms. Unlike retailers, which purchase finished goods for resale, manufacturing firms incur costs to manufacture products. All costs associated with manufacturing a product are considered product costs, and they are capitalized, that is, are recorded as assets, part of inventory. And subsequently, when they are sold, their costs are matched with revenues, and the company records an expense called cost of goods sold. Again, a primary challenge of management accounting is the proper matching of revenues and expenses. In answering the first question, are we profitable, we only need to allocate costs over time periods. But to answer the second question, which products are profitable, we must allocate indirect costs or overhead both over time and across various products and/or jobs.